Welcome to Phillip Futures Market Watch. My name is Tan Chi Tat, investment analyst with Phillip Futures. Today, we'll be focusing on the Ukraine crisis. What has happened and is going to happen next? Also, how will benchmark crude prices be affected by the developments in Ukraine? Amid the Ukraine crisis, we witnessed growing tensions between Russia and Western powers, namely the US and Europe. Friction between the two heavyweights brought us back to the Cold War era, where skepticism between the Western Bloc, made up of the US and NATO, and the Eastern Bloc, made up of the Soviet Union and allies in Warsaw Pact, resulted in an almost half a century-long standoff. Back to the present, what caused the eruption of the Ukraine crisis? Ukraine citizens are keen to pursue stronger integration with the European Union. However, hopes were shattered when former Ukraine President Viktor Yanukovych refused an association agreement between the two parties, causing widespread public dissent in Ukraine, which escalated into internal unrest. Pro-Russian Yanukovych was eventually ousted, prompting Russia's intervention. On March 3rd, benchmark crude prices jumped by almost $2 after Russia declared rights to invade Ukraine. Brent crude leveraged on the crisis to break through $110 after trading between the tight range of $105 and $110. Immediately, Russian troops were deployed to surround Crimea and tensions ran high. Prices rallied on possible disruption to crude oil supplies from Russia. Oil disruption could arise in an event of war, as domestic consumption for crude oil in Russia will increase, hence curbing crude exports. Furthermore, possible destruction on oil infrastructure and facilities in Russia during wartime would also disrupt oil supplies. As such, crude oil prices rallied on heightened geopolitical risk in the crisis. Shortly a day after the rally, crude oil prices plunged on unstable footing. Russian President Vladimir Putin recalled troops back to base from a military exercise. Markets perceived the move as easing of violence, despite denials from Russian officials that the recall was independent of the Ukraine event. Furthermore, Putin emphasized that the deployment of aggression against Ukraine would only be used as a means of last resort. New developments in the Ukraine incident pointed towards a reduced likelihood for an outbreak of war. Earlier rallies proved to be unsustainable, causing benchmark crude prices to lose support and plunge subsequently. The final avalanche of crude oil prices arrived not long after the previous plunge, as the US seek to resolve the Ukraine crisis via diplomatic means. Despite no significant breakthrough at the Paris talk, there were follow-up efforts to resolve the differences between Russia and Ukraine through peaceful terms. This resulted in the cooling of geopolitical risks, as an initial speculation of war has been downplayed to war of words between the involved parties. On the other hand, Russia threatened to sell down on the US dollar as a reserve currency and default on US loans if sanctions were imposed on the nation. The warning may have deterred effective Western intervention in the process of merger between Crimea and Russia, keeping aggression at bay once again. As the events settled, crude oil prices eased further. Ukraine is strategically important to Russia as it acts as a buffer zone between Russia and the West. Crimea has a large Russian-speaking population. Hence, during the referendum, 97% of Crimea's citizens voted to join Russia. However, Western powers cried foul over the merger between Crimea and Russia, citing violation to international laws. Sanctions were eventually imposed on a localized scale in terms of travel bans and asset freezes on individuals who advocated the Crimea secession from Ukraine. However, why were widespread sanctions not imposed upon Russia by Western powers? This is because the Western powers are aware of the serious repercussions if implemented. To begin with, as mentioned earlier on, Russia may retaliate by selling down the US dollar as a reserve currency and default on US debts. This will lead to a sharp depreciation in the greenback. Furthermore, Europe, being highly dependent on Russian energy, would be vulnerable to supply cuts. Just as when we thought that the episodes of dramatic events have come to an end following Crimea's annexation, new developments sprouted. Tensions reloaded in Ukraine once again as pro-Moscow uprisings in the nation's cities over the weekend sparked off fears of fragmentation. The re-enacting of Crimea scenario threatened to destabilize Ukraine, leading to the possible separation of eastern Ukraine from the rest of the nation. Western powers warned Russia of stiffer sanctions for their intervention in the prevailing Ukraine brawl, resulting in an escalation of geopolitical risks which supported crude oil prices. This is a daily chart of Brent crude oil May 2014 contract. Brent crude prices underwent successive sessions of gains after rebounding off the 105 level. The short-term green moving averages narrowed towards the long-term red moving averages, suggesting possible upside. Similarly, the black MACD line managed to cross above the red signal line, denoting dissipating downward momentum and possible upward price movement. Resistance is pegged at 113 and support at 105.2. FIT Futures offers trading in Brent crude oil futures. For more information, please approach any representative from FIT Futures for further discussion. Thank you and stay tuned for more Market Watch videos.